26 additional problem. Here we can see X, Y and Z are partners sharing profits and losses in the ratio of 3:2:1. Their balance sheet as at 31st March 2018 was as follows. You can see the liability side and the asset side is given to us. Sundry creditors is valued at 51,000. Employee provident fund is valued at 9,000. The capital of the three partners X, Y and Z are given as 1,52,000, 1,48,000 and 84,000 respectively. So the total of the capital becomes 3,84,000 and the total of the liability side is 4,44,000. Now let us move on to the asset side, where we can see building is given as 2 lakh, machinery is 80,000, sundry debtors is 1 lakh. There is a provision of 10,000 which has been subtracted and therefore the value becomes 90,000. Stock is valued at 40,000. Cash at bank is 22,000 and profit and loss account, which is a loss accumulated, 12,000, which makes the balance sheet tally at 4,44,000. After this, we are informed that X has retired on that date and it was decided to make the following adjustments. So what are the adjustments? Number one, stock to be depreciated by 40%. So whatever the value of stock is, it will go down by 40%. A sale of old paper and material realized 1,000. Now this is a very important entry which you must understand, that whenever you are selling old papers and materials and you are realizing 1,000, that is being passed through the realization account. Money is coming in the revaluation account. Now next one, you can see that profit provision for doubtful debts are to be increased to 17% of the debtors. You can already see that there is a provision of 10,000 and it will now be increased to 17%, so it will become 17,000. So there is an increase of 7,000. Machinery depreciated by 40%, building appreciated by 20%, very simple adjustments. Partners paid 10,000 to the family of an employee who died of heart attack. Now here there is again a compensation being paid, and whenever there is a payment being made, it will also be passed through the revaluation account and the money has been paid over here as 10,000. Goodwill is valued at 30,000. This is the goodwill of the firm, so we have to find out the goodwill of the retiring partner. Y and Z decide to share future profits in the ratio of 3:2 and not show goodwill in the books. Generally, we do not show goodwill in the books. After that, you can see the last one, that is the seventh one. Y and Z would introduce sufficient capital to pay off X. That is, the retiring partner is to be paid off, and thereafter a sum of 25,000 as a working capital in the manner that their capital will be in the proportion of their new profit sharing ratio. So what is their new profit sharing ratio? Their new profit sharing ratio is 3:2, so it will be in the 3:2 ratio. And we are asked to prepare the journal and prepare the balance sheet of the new firm. So here we are not asked to prepare the revaluation account, but whenever we are asked to prepare the balance sheet of the new firm, it is very important that we understand that we cannot do it until and unless we prepare the capital account. Then only we'll understand which partner has to be paid how much money and which partner will bring in how much money. You can see over here that X is to be paid off how much and how much money will Y and Z bring in, so that their capital is adjusted in the new profit sharing ratio. After reading and analyzing the question, now let us come to the solution of sum number 86. Here we know that there are three partners X, Y and Z, and their PSR is 3:2:1. X has retired, Y and Z continuing the business, and you can see their PSR is given to you as 3:2. So now we have the old profit sharing ratio and the new profit sharing ratio. Whenever we have the old profit sharing ratio and the new profit sharing ratio, it becomes very important to find out the gaining ratio. So let us find out the gaining ratio, the formula of which is new ratio minus old ratio. For whom do we find it out? For Y and Z. So for Y, what was the new ratio? The new ratio is 3/5. The new ratio is 3/5. What is the old ratio? The old ratio, see very carefully, it is 2/6. So what is the LCM of 5 and 6? It is 30. So 6 into 3 gives you 18. 5 into 2 gives you 10. So the 8 is to 30. Now for Z, what is Z's share? 2/5 new share. What was Z's old share? 1/6. So see very carefully, 30 12 minus 5, that gives you 7 by 30. So we come to the conclusion that the gaining ratio among Y and Z is 8:7. Now this is the first thing which we have done. Why we have done this? You can see the goodwill of the firm is given to you as 30,000, and this 30,000 will be obviously found being, first we'll find out what is the share of X, and then we'll do the treatment of the goodwill. So first and foremost, goodwill of the firm is 30,000. So what will be the goodwill of X? The goodwill of X will be 3 by 6, or half of 30,000, which is 15,000. And 15,000 will now be distributed in the ratio of 8:7, which is the gaining ratio. It becomes very easy. 8,000 to the first partner, that is Y, and 7,000 to the next partner, that is Z. So we'll start off with the journal entries. First we'll concentrate on the journal entry for the goodwill, and then we'll concentrate on the internal journal entry. If you see very carefully, there is one internal journal entry over here. There is a profit and loss account given in the asset side of the balance sheet as 12,000, and I have always told you, whenever there is any internal adjustment, that has to be done first. So first let us start with the treatment of goodwill. And you know what is the journal entry very clearly. Gaining partners capital accounts will be debited, and the retiring partners capital account will be credited. So the journal entry over here, very carefully see, Y's capital account debit, Z's capital account debit, to who's retiring, X capital account. What was the share of X? 15,000 we have calculated. So over here, 8,000, 7,000 and 15,000. This is the first journal entry which we are doing. Y's capital account, Z's capital account, to X capital account, 8,000, 7,000, 15,000. I am not drawing the format. Till now, I'm sure you know the format: date, particulars, ledger folio, amount and amount, debit, credit. Now the second one will do the internal entry for the profit and loss, which is there at 12,000, and how it will be written. It will be written among X, Y and Z in their profit sharing ratio 3:2:1, and therefore we'll do that. So it will be X's capital account debit, Y's capital account debit, Z's capital account debit, to profit and loss account. Please see very carefully. Asset side of the balance sheet has the profit and loss of 12,000, which means there is accumulated loss of 12,000, which needs to be written off among all the partners in their old profit sharing ratio, which is 3:2:1, and therefore it will be 6,000, 4,000 and 2,000. So we are done with two journal entries. That is the first journal entry for the treatment of goodwill, and the second journal entry for the treatment of profit and loss, which appeared in the asset side of the balance sheet. Now, if you have read this question, we are asked to make the journals, and then we are asked to make the capital account and find out. Okay, so first we'll concentrate on the journals based on the information which is given to us. So you can see there is basically a revaluation of stock, and the value of stock has gone down by 16,000. So the first treatment will be revaluation account debit to stock. Because the value of stock goes down, and whenever the value of any asset is going down, the journal entry will be revaluation account debit to the stock, to the asset, and here the asset is stock. The second one, you can see very important entry. You have sold something and you have received the money 1,000, and that will be passed through the revaluation account and bank account. Understand it very carefully. The journal entry is bank account to revaluation account, because you are receiving 1,000 rupees by sale of old things over here. Therefore the journal entry will be bank account debit to revaluation account 1,000, 1,000. The next entry which is being given to us, it's very important for us to understand that the provision for doubtful debt is increased by 7,000. The question says is very clearly that a provision for doubtful debt will be increased by 7,000. Therefore, the treatment of that will be revaluation account debit to provision for doubtful debts 7,000. 7,000. I hope it's very clear how it has been increased by 7,000, everybody. Now see, machinery is basically being depreciated and the value is going down by 32,000, and therefore why? Because it is mentioned very clearly 40%. 40% of 80,000 will be 32,000, and therefore the next journal entry is revaluation account debit to machinery. Revaluation account debit to machinery, find 40,000 of find 40% of 80,000, you will get 32,000. Is it very clear? Now, after that, we can see the value of building has been appreciated. The value of building has been appreciated by 20%. The value of building is given to you as 2 lakh, and if you calculate 20% of 2 lakh, it becomes 40,000. So the next journal entry which we have is building account debit to revaluation. Building account debit to revaluation, and you can see very carefully it's 40,000. 40,000. Why? Because it increased by how much? Increased by 20%. So we have done with the journal entries over here. First journal entry was a revaluation of stock. The value of stock fell down by 16,000. You can see the next piece of information which is given to us, that we sold old newspapers and received 1,000 rupees. That should be passed through the revaluation account, which we have done it. There was an increase in the provision of doubtful debts by 7,000. The machinery was depreciated, by 40%. And if you calculate 40% of 80,000, it becomes 32,000. The building devalued, that is appreciated by 20%. 20% of 2 lakh gives you 40,000. Therefore, over here, building to revaluation 40,000. Apart from that, there are other entries also, which we'll do very soon. Now the next entry talks about a compensation being paid to the family, and you can see whenever the money is being paid, the money is going out, and that should also be routed through the revaluation account, and the amount of money which is being paid is 10,000. Therefore the next journal entry will be revaluation account debit to bank, because the money is going out, and we are doing the journal over here. Revaluation account debit to bank, and the value, see very carefully, the amount is 10,000, 10,000, because that is the compensation being paid. Now, after passing all the journal entries based on revaluation, you can see over here 1, 2, 3, 4, 5, 6 entries for revaluation has been passed, and now we'll actually find out the result of revaluation. That means, will it be a profit or loss on revaluation? You can very clearly see that the amount in the debit side of the revaluation account is 16,000, 7,000, that makes it 23,000. 23,000 plus 32,000 gives you 55,000, and the amount in the credit side we can see over here is 1,000, plus we have 40,000, so 41,000, and there is another amount of 10,000 in the debit side. Therefore, that actually gives us the total of the debit side is 16,000 plus 7,000 is 23,000. Plus 32,000, 55,000 plus 10,000, that gives us the total of the debit side as 65,000, and the total of the credit side, be very careful over here, 1,000 and 40,000, that gives us a 41,000. Therefore, we can come to the conclusion that there has been a loss of 24,000. So 24,000 is a loss on revaluation, and that will be written in their profit sharing ratio. If you remember, the profit sharing ratio of X, Y and Z was 3:2:1, and we'll write down 24,000 in that ratio, 3:2:1. So we'll do the journal entry over here, and the journal entry will be X's capital account debit, Y's capital account debit, Z's capital account debit to revaluation account. 24,000 in what ratio? 3:2:1. So 12,000 first partner, 8,000 second partner, and 4,000 the last partner, and therefore this is the treatment of the loss on revaluation. So now I have concentrated on the journal entries, all journal entries related to the revaluation. See very carefully, the revaluations are 1, 2, 3, 4, 5 and 6 entries which were there for revaluation, and as a result we have actually found out a loss of 24,000. I've explained to you over here the debit side total is 65,000, the credit side total is 41,000, therefore there is a loss of 24,000. The question does not ask us to prepare a revaluation account, so we're not going to prepare that. After doing that, we'll move on to the next part of the question to understand very carefully that what has been done. The retiring partner has been paid off the money and the continuing partners are actually bringing in capital in such a way that their capital balance will remain to the new profit sharing ratio, and if you know, the new profit sharing ratio is 3:2. After preparing the journal entries, now let us move on to the capital account, because it is very important to prepare the capital account. Only by doing that we can actually find out how much has to be paid to X and how will the capital of Y and Z appear in the balance sheet of the new firm. Though over here we have to be very careful by the preparation of the capital account, and we see how it is to be done. Now you see very carefully the balance given in the balance sheet of our X, Y and Z. The capital account balances are X 1,52,000, Y 1,48,000 and Z 84,000. So we start with that entry by balance brought down. And if you remember, for X the value is 1,52,000. For Y, the value is 1,48,000 and Z 84,000. Now the next entry over here is the treatment for goodwill. If you remember very carefully, by Y's capital, by Z's capital, the journal entry which I had done first, if you remember, the gaining ratio had come as 8:7 and the share of X was 15,000. Why? Because the share of the goodwill of the entire firm was 30,000. So Y's capital by Z's capital, and we have over here 8,000 and 7,000. Please go to the debit side, right over here to X's capital and the entry in Y's account and Z's account, 8,000 and 7,000 respectively. Now apart from that, we also had a loss which was there in the balance sheet, if you remember, and that basically was to be treated. Okay, so we will do the entry to profit and loss account, and if you remember, we had passed the second journal entry 6,000, 4,000 and 2,000. So 6,000, 4,000, 2,000. The next entry is based on the entire revaluation account, and if you remember, the last journal entry for the revaluation account was X's capital account debit, Y's capital account debit, Z's capital account debit to revaluation, because there was a loss on revaluation of 24,000, and therefore the entry to revaluation, that is for the loss transfer. You can write loss if you want, it is not required actually to write it. 12,000 for the first partner, 8,000 for the next partner and 4,000 for the last partner, because the PSR was 3:2:1 and the total loss was 24,000. After doing this, we can easily find out how much money has to be paid to X, and if you remember, X has been paid off. Okay, so do this entry to bank and find out how much has to be paid to X. Let us do the totaling, and let us after that show the working. The total over here is coming to 1,67,000. 1,52 plus 8 plus 7 gives you 1,67,000. So here 1,67,000 minus 18,000. That gives you 1,49,000. This is the amount of money which has to be paid off. This is the amount of money which has to be paid off to X. After that, let us find out how much is the outstanding capital of Y and Z. See very carefully, I am showing you the calculations over here. So we are actually making a payment. X is paid how much? 1,49,000. Now, how much is basically left with Y? So, Y's residual capital, we have over here 1,48,000 minus 8,000, 4,000 and 8,000, that is 20,000. So that gives us over here 1,28,000. For Z, we see very carefully 84,000 minus 7,000, 2,000 and 4,000, that is 13,000. That gives you a value of 71,000. Apart from that, we will be very carefully understanding this fact that there should be a working capital balance of 25,000. If you see very carefully, the cash at bank is already given to us as 22,000, and we have passed two journal entries in which bank was involved. One in which bank was involved with 1,000 money receiving, and one it was involved in money paying. If you remember, we had done a journal entry for bank to revaluation account 1,000, 1,000, and we had also done a journal entry revaluation account to bank 10,000, 10,000. Therefore, we can understand very clearly how much money will have to be brought in by showing a very simple calculation for the bank one. Please see very carefully. Bank already 22,000 was there. With that, we add 1,000 which has come in. We subtract 10,000 which is there, which has been paid off. Now please see very carefully. 22,000 plus 1,000, that gives you 23,000 minus 10,000, that gives you a figure of 13,000. And we have been said that 25,000 should be the working capital. 25,000 should be the working capital. Therefore, 12,000 more is to be required. Repeat again, 12,000 more is required. Very clearly understand this. So now you add 12,000 over here, because it has been said that the working capital requirement is 25,000. So you can see 1,000 had actually been coming in and 10,000 has gone out. As a result, we have a bank balance of 13,000. To make the bank balance as 25,000, 12,000 more has to be brought in. So now we have the figures 1,49,000, 1,28,000, 71,000 and 12,000. If you add all, okay, you get a figure of 3,60,000. Now, please understand very carefully, the question has said that the capital of the partners will be brought according to the new profit sharing ratio, which is 3:2. So we'll divide this 3,60,000, which is the capital of the new firm, in the ratio 3:2. So 3,60,000 divided by 5 multiplied by 3 gives you 2,16,000. Again, 3,60,000 divided by 5 multiplied by 2 gives you 1,44,000. Okay, so therefore we can come to this conclusion that the capital balance of the second and the third partner Y and Z will be 2,16,000 and 1,44,000 respectively. So we'll write over here to balance carried down, and for the second partner, that is Y, it will be 2,16,000. For the third partner, that is Z, it will be 1,44,000. Now, with this, we can easily find out how much money has to be brought in by Y and Z. One thing has to be said very clearly over here. The money which has to be brought in over here is not only enough to pay X, but also to have the working capital as 25,000. Okay, so now let us see over here what is the total. 2,16,000 plus 20,000 gives us 2,36,000. Please see very carefully over here. 2,16,000 plus 8 plus 4 plus 8 gives us 2,36,000. So 2,36,000 minus 1,48,000 will be the amount of money which has to be brought in. So 2,36,000 minus 1,48,000 gives us a balance of 88,000. So this is the amount of money which has to be brought in. 88,000 has to be brought in by Y. Now if you see the total of Z, 7,000 plus 2,000 plus 4,000 plus 1,44,000, it gives us a total of 1,57,000. Now 1,57,000 minus 84,000, if you subtract it, 1,57,000 minus 84, we are getting a balance of 73,000. So therefore, over here we are getting 73,000. So we can come to this conclusion very clearly that the amount of money brought in by Y and Z to make their capital as per as the new profit sharing ratio 3:2 will be 88,000 and 73,000 respectively. And obviously the last entry, we should not forget that by balance brought down of the two continuing partners Y and Z is 2,16,000 and 1,44,000 respectively. This concludes our capital account. Why have we made the capital account? Please understand very carefully. We have made the capital account for two reasons. Number one, to find out how much money has to be paid to X, because a journal entry has to be passed for that. And you know, a journal entry, whenever money is paid, a journal entry will be excess capital account debit to bank. Okay, excess capital account to bank, and the amount will be 1,49,000, 1,49,000. Also, it has been made to find out what will be the capital balances of Y and Z. We have calculated the capital balance of Y and Z as 2,16,000 and 1,44,000 respectively, and that has helped us to know the amount of money which Y and Z has to bring in. You can see very carefully, Y has to bring in 88,000 and Z has to bring in 73,000 so as to make their capital balance as per the new profit sharing ratio 3:2. After preparing the capital account, now we'll concentrate on the balance sheet. Obviously, you will wonder why did we prepare the capital account, as the question did not ask to prepare the capital account. They have asked us only to pass the journals and then do the balance sheet. But it is very important that we prepare the capital account, because if we do not prepare the capital account, we will not come to know how much capital will the continuing partners have and what is the amount of money the retiring partner has to be paid off. So you can see very carefully that I have already drawn the balance sheet for you, and I'll explain to you how the balance sheet has got these following figures. Concentrate at the top the date of the balance sheet. It's written at balance sheet as at 31st of March 2018. That is the date of retirement of X as the first partner. If you remember, there were three partners in this question, X, Y and Z, and Y and Z is continuing as it is shown. Now, if you see very carefully, we have a building of 2 lakh, and the adjustment which was given, the value of building was appreciated by 20%. So if it is appreciated by 20%, I have written over here add appreciation 40,000, because 20% of 2 lakh is 40,000. So the outer column figure goes to 2,40,000. The next piece of information is that machinery is depreciated by 40%. 40% of 80,000 is 32,000, and see, you can very carefully, machinery 80,000 less depreciation 32,000, outer column 48,000. The next piece of information, sundry debtors. It already had a provision of 10,000, but the adjustment has said that the provision is increased to 17% of debtors. Now, if you calculate 17% of 1 lakh, it will become 17,000, and that is the reason why over here we have 17,000. In the question, it is given as 10,000. So there is an increase of 7,000, which we have already shown in the journal. Now, 1 lakh minus 17,000 gives us 83,000 stock. There is a decrease of 40% in the stock, and if you calculate 40% of 40,000, it gives you 16,000. If you remember, that was the journal entry which we had done, the first journal entry of revaluation account. So 40,000 minus 16,000 gives us 24,000. This part is very important, the entry for cash at bank. Now, if you see, the balance of cash given in the balance sheet is given as 22,000. There are two pieces of information which is given. One, 1,000 rupees we have received by the sale, and 10,000 rupees we have paid as a compensation to the deceased partner, to deceased employee. So this is the money paid. After preparing the capital account, we have found out that Y and Z has brought in 88,000 and 73,000 respectively, and the money which has to be paid to the retiring partner was 1,49,000. And we have also been given one information that the working capital of the firm will be 25,000. Therefore, after doing this all the working, we see that we have 25,000 in the outer column. So this concludes the asset side of the balance sheet, and the total of the asset side of the balance sheet comes to 4,20,000. We know that the balance sheet should tally at a particular given point, and here the balance sheet has tallied at 4,20,000. Let us now concentrate on the liability side. If you remember, that liability side there were two figures, sundry creditors and employee provident fund, which does not have any adjustment, and therefore it is written as it is. That is, sundry creditors 51,000 and employee provident fund 9,000. The only thing which is changing over here is capital of Y and Z, because the capital is adjusted according to the new profit sharing ratio, which is 3:2. You can see over here 2,16,000 and 1,44,000. So the capital becomes 3,60,000. So with this we have completed sum number 86, which was the last question which I would wanted to solve from the additional questions, and very soon we'll start off with the new chapter.